Next, let's talk about the signaling content of dividends. And this again is related to what we talked about in the last class, where there is information asymmetry in the real world. Managers know a lot more about what's going on relative to outside investors. Okay, so outsiders, then how do they decide what to do? Do they decide based on what managers say or what managers do? They decide based on so they decide based on action. So the actions of the managers send out signals to the outside world. That's point number one. Point number two is the outside world people, and this is an established fact, that managers at companies do not like to change dividends. So generally, another way of putting it is that dividends are sticky. So once a company like say FFC has a particular reputation that they pay a certain amount of dividend per share, then companies don't just like to randomly sometimes bump up the dividend, sometimes bump down the dividend. Most companies like to have a steady dividend, which hopefully increases at a gradual pace along with the economy or along with the pace at which the company is growing. So given these two facts, that managers know more, and given the fact that everybody knows that managers don't like to change dividends, what are the signals that outsiders can see based on manager actions? Okay, the sort of signals that have been taken in the past, generally dividend initiation or increase are seen as positive signals. So the point being this: if you are the outsider, you know that as a manager I will increase my dividend if I believe that in the long run I will have enough cash to keep paying that higher dividend. Okay, when I pay a higher dividend, am I setting an expectation that I'll continue to do this in the future? Yeah, and if I'm setting that expectation, I as a manager don't like to set an expectation and then not fulfill it. So I will only bump up a dividend if I think that I have good cash flow prospects in the foreseeable future. So then what sort of a signal am I sending by increasing dividends? I'm generally sending a positive signal. Okay, so that is obviously that doesn't always, some people might actually think that okay, I'm sending out a signal because my investment opportunities are less, so it's a mixed bag, but in general it's taken as a positive signal. Okay, because what if I send out that signal, I raise the dividends, but then I don't live up to it? What do you think will happen in the stock market? My stock will take a hammering. Okay, and I as a manager know that. Anytime a stock doesn't deliver in terms of the expectations that management has set, that's when the stock price takes a huge hit. Okay, and in general, a decrease in dividends or just slashing dividends to zero is generally seen as a negative signal. Again, these are not hard and fast rules, these are just rules of thumb, so just generalizations. Okay, so that's the signal that is sent out. Okay, let's look at this example now. Okay, so suppose the management of a company with, this is critical, poor future prospects recommends to the board that we should increase our dividends. Managers explain to the board that investors may then believe that the company has positive future prospects leading to an increase in value. Okay, so now basically the managers are trying to play a game here. Okay, they know that the prospects are weak. Just to boost up the price and maybe to get a higher bonus, they want in the short run to send a positive signal and send up the price. Why is this a bad idea? It's a bad idea because that increase is not going to be sustainable, and maybe for 1 quarter or 2 quarters you'll pay the higher dividend, but after that you will not have money to pay dividends, and then when you cut your dividend later, then your stock price will take a big hit. So that's the idea. Now in this reading there are several small examples where they are not necessarily questions, they just give you a scenario and say okay, this company did X, Y, Z, and I would advise you to just pause the video and read those examples as they come. Okay. Next, agency costs. So agency costs can be high at large corporations. What are agency costs? Yeah, this is the cost where management and shareholders have different objectives. The cost of trying to align the objectives of management and shareholders are called agency costs. These can be partly controlled by high payouts of dividends. Why? Because if there are high payout of dividends, then the cash flow that is left with management to play around with is less, and there is less damage that management can do. Okay, let's see you do example 5 now. This touches on basic governance, which we've seen in level 1 and we'll see more of in the next class. Yeah, so look, so both of them, the B has bad governance. So where is there a higher risk of higher agency costs? So whenever there is weak corporate governance, even though we've not done that topic yet, but still you should know that if there is weak corporate governance, there is a greater chance that management is not acting in the interest of shareholders. Okay, then if that company, even though it's generating good cash flow, but if the opportunities are not good, what should happen with the cash flow? Not eventually, as in if a company is generating a lot of money and opportunities are not good, the most sensible thing to do is to give that money to the shareholders. Increase your payouts or do a share repurchase or something like that. So rather than potentially having money when there are not good opportunities, then management might just decide that everybody needs a better quality car in the company. Okay, so better than that for shareholders is that shareholders get that money through dividends. Okay, A, we are assuming has good opportunities and good corporate governance, so shareholders might be comfortable with that company just keeping the money. Also, I'd now recommend you read example 6. It's a short example. Okay, the question is that are we contradicting earlier slide? So two general points. First of all, these are not hard and fast rules. Second, the point here is very straightforward. If you have company B, you are the shareholder of company B. Okay, you know two facts. You know one fact that the corporate governance is weak, which means that the agency costs are potentially high. And second, you know that investment opportunities are also low. Okay, in this sort of a situation, would you like your managers sitting on top of all the profits that are being generated? No. So you would rather that instead of retained earnings, the money is paid out as dividend. So it's pretty logical. Yeah, in this case, the bird in hand applies very well, because you would much rather just say, okay, management, rather than leaving money with you and you know, doing stuff that does not maximize my value, just hand over the extra cash. I'll do something else with it. Okay, so now we are on to section 3, which is what are the factors which affect dividend policy. There are, all the factors have been listed on this page. In the curriculum, you will find that there is somewhere between half a page to a page on most of these factors. I'll just give you the core explanation right now, which is what you need. On taxes, there is a lot more detail, and there is a separate learning objective that you need to cover with taxes, so that we'll cover in detail. But other factors, let's just go over on this slide. Now, we were briefly talking about this earlier. Investment opportunities. Companies that have good investment opportunities will obviously prefer to pay less dividend. Why? Because if you have an opportunity, in the real world, transactions exist, there are flotation costs and so on. So the last thing you want to do is go to the market to try to raise money when you have money of your own through your own operations. So all else equal, good investment opportunities means a relatively low payout. Okay. Second, expected volatility of future earnings. The quick statement here is, the higher the volatility of your earnings, the lower the payout ratio. Why? Because you want to have a steady, stable dividend payout. If you are just going up, increasing your dividends when earnings are up and decreasing your dividends when earnings are down, that doesn't send a good signal to the market. So what you would roughly do is, if you have high volatility of earnings, you would try to figure out what sustainable dividend can you maintain over the foreseeable future. For a very stable utility company, or let's just take a company like FFC. So if FFC, given all its contracts and customer base, it has a fairly predictable earning stream, and hence can be comfortable paying out most, or if not all, of its earnings as dividends. Another company that is very unpredictable will obviously pay less dividends relative to earnings. Financial flexibility. Okay, what does this mean? Companies that pay high dividends then have less financial flexibility because they don't have the money to, maybe if a new opportunity comes up, to buy another company or to go for a good investment somewhere. If a company is not sitting on cash, then it can't take advantage of that opportunity. A classic example is Microsoft, where Microsoft has over the years paid, initially they didn't pay any dividend, and then when they started paying a dividend, it was a very small dividend. What did that mean? That didn't mean that Microsoft wasn't making money. They were making a ton of money, and all that money was going into their cash. So with that extra cash, that gave Microsoft the financial flexibility that if there was a good company to buy, they could buy that company very, very fast. There is a small example in the curriculum. This is just in the text, where GE, one of the largest conglomerates in the world, their CEO Jeff Immelt, he made an announcement that GE, which had been consistently increasing dividends for almost either I think it's 70 quarters or 70 years, then decided to cut dividends. And the explanation he gave was that we are increasing our financial flexibility. We want the ability to have a cash store so that we can respond more quickly to good opportunities. Okay. Next point is tax considerations. There's a whole bunch of stuff on this, so I'll deal with this separately. Flotation costs. If you first of all, let's understand the two broad kinds of flotation costs, and then the impact of flotation cost on dividend policy. Okay. One flotation cost is the obvious one. When you raise money through debt markets or through equity markets, it's not free. In the real world, transaction costs do exist. So you have to pay the investment bankers for helping you raise money. So that is flotation cost. The other flotation cost, which is implicit, is any adverse impact on market prices. We discussed this in the last class. When a company issues equity, that sends a negative signal. If that negative signal causes a reduction in equity, that also is a flotation cost. So because of these, if in an environment where flotation costs are high, what do you think the dividend policy will generally be like? You would pay out lower dividends because you would not like to be in a situation where you need to go raise money from the market. Okay, so higher the flotation cost, lower the payout ratios. And in this context, there is a small example 7 that I want you to read. And then finally, contractual and legal restrictions. In some countries, there is a legal obligation that companies need to pay a certain amount of their earnings as dividends. So obviously that legal requirement has an impact. If you recall from level 1 fixed income, there was this concept of bond related covenants. One covenant might be that you cannot pay certain dividends or more than a certain amount of dividends. So those covenants might also come into play when companies are deciding on their dividend policy. Okay. Another short example that I want you to read is example 8. So this is good because it tells you briefly why Toyota Motor Company cut its dividends, and then several of these factors are explained. So it's just like half a page, but good reading. What we've effectively done here is covered LOSD, which explains the factors that affect dividend policy. The one that we'll discuss in more detail now is tax considerations. Okay. Now, broadly speaking, when it comes to dividends, there are 3 different kinds of tax systems that we need to be aware of. Different countries have different tax systems. The one in the US is a double taxation system. Then I think France or Germany has this tax imputation system. and then we have a split rate that exists in some other countries. Let's do the double taxation. I'll give a high level explanation of what double taxation means and then get into numbers. Double taxation means this. Let's say you are shareholders. Then when as shareholders you own the company. Double taxation means that you pay taxes 2 times. Why? As if you own a company, when a company makes profits, let's say earnings before taxes, EBT, then the company pays taxes. Okay, so that's your first hit. Then you get a dividend. Do you pay a tax on the dividend? You also pay a tax on the dividend. So when you combine those two, it's effectively double taxation. Okay. Now, the example that we have here is US centric. I think before 2003, the tax rate on dividend was a hefty 39.6%, and then it was subsequently reduced to 15%. The left column is calculating what your effective tax rate is under both these regimes. Okay, so if the dividend tax rate is 39%, let's say that the corporate tax rate remained at 35%. For $100 earnings before tax, so this is your EBT, is $100. First, the $35 gets cut and your net income is 65. Now, assuming for simplicity a 100% payout ratio, how much dividend do you get? 65. If on 65 you are paying this 39% tax, then you are paying 39.6% of 65, which is 25.7. So effectively on $100 of corporate earnings, the amount coming to each owner is 39.26. So overall, when you take both the tax hits, the tax rate is 60.7%. So if you obviously on an exam, you don't have to go through all this calculation. Effectively, if you need to find the tax rate, what you do is this. The effective tax rate is the corporate tax rate, which is 0.35, plus 1 minus the corporate tax rate, so 1 minus 0.35 multiplied by the individual rate, which is 0.396. So all this is saying is, okay, on your $1 of earnings, that gets cut straight away, nothing you can do about that. And then on your remaining 65 cents, you pay another 39% of that. So quickly do this calculation and you have your effective tax rate. Can you read and interpret what's going on here? So if I ask you very quickly that, okay, let's say that the income, the individual rate has been reduced to 15%. What's the effective tax rate very fast using this formula? So it would be the 35% plus 0.65 multiplied by only 0.15 now. Okay, so that will give you your effective tax rate. So this is the double taxation system. Okay, you take a pretty, even with a low tax rate here, you still pay a effective tax rate that is pretty high. Okay. Now, the second system that you need to be aware of is the tax imputation system. Now, actually a quick point, in the earlier slide where those taxes are so high, in that sort of a system, companies would prefer, or investors might prefer, more capital gains as opposed to dividends. Okay, especially in the world where the dividend tax rate was 39%, obviously dividends are not being encouraged. Okay, next is the tax imputation system. Here we say taxes on dividends are effectively levied only at shareholder level. What does this mean? This means that at least in developed countries, there is, even for dividend tax, the shareholder pays a rate based on his marginal tax rate. So if you are rich, you will pay maybe, let's say we are in the Scandinavian countries, so rich people pay a high rate of say 47%, and poor people might pay a lower rate of 15% on the same stock, same dividend. Now, high level explanation is that the tax is structured such that effectively on the income you are only paying 15%. How does this work? Let's say on a company the pre-tax income is 100, the tax rate, corporate tax rate is 30%, so you cut 30, so your net income is 70. Again, let's assume that the entire net income is paid as dividend. Okay, now if you are in the 15% tax bracket, then that is saying that effectively on $100 you should only be paying 15, but how much have you already paid? 30. So the tax is minus 15, which means that you get a refund. The government actually sends you money, which is nice. Okay, so that is the marginal tax rate. Okay. What about if you are rich and in a high tax bracket, then what will happen? So up to this point the explanation is the same, but now your tax due is 47, you've already paid 30, so you pay an additional 17, so you end up with an effective tax rate of 47%. In the actually in this, so the question is, in the 15% case, would a company want to just only pay out dividends? The point in this scenario is there are different shareholders with different brackets. So if we, just to build on the comment that was just made, if we assume we live in a world where everybody is effectively in the 15% rate, then actually dividends would be quite favorable. It also depends on the relative tax rate on capital gains. Let's say that the capital gains are 0. So what you really need to do is, from a company perspective, you look at on average what's your population like, and effectively where is the taxation more, with capital gains or dividends. And the final system that you need to know is the split rate system. There are different tax rates for retained earnings versus earnings that will be distributed. What does this mean? This means that obviously when a company makes earnings, what are the two things that it can do? Either distribute or retain. Let's say that the pre-tax earnings are 200, the retained earnings are, let's say, 100. That means it is giving out 100 as dividends. So on the, let's say the pre-tax earning is 35. I'm sorry, the tax rate on retained earnings is 35%, and the pre-tax earning allocated to dividends is 100. Let's say that, so in this case what's happening? The tax on dividend is lower. Why do you think it's lower? Because the shareholder will get the dividend and then will have to pay a tax on the dividend also. Okay, so what's happening here? So $100 is being paid out as dividend. 20%, what's this 20%? At the corporate level? Yeah, paid by whom? By the individual or by the company? Yeah, this 20% is paid by the company. How much does the shareholder get? He gets 80, and then if the shareholder tax rate is 35%, then he pays the 35% on his 80, so the shareholder gets 52. So that means from $100 the shareholder got 52, so in this case the effective tax rate is 48%. What we've done over the last 4 slides is address LOSE, which is calculate and interpret the effective tax rate on a given currency unit under double taxation, which we did, split rate, and tax imputation regime. So, okay. So the question is, can we just quickly go over this again? So let's do that. A split rate system, the philosophy is that the government imposes 2 taxes. Okay, so if a company has net income of, or pre-tax income of 200, and let's say that of this 200, it intends to allocate 100 to retained earnings and 100 to dividends. The tax rate on the split means that you can split this down the middle or split this. The tax rate on the retained earnings is different from dividends. The corporate tax. The corporate tax on retained earnings would typically be high relative to dividends, because the tax on dividends because shareholders will get this dividend and pay tax on it again. Okay, so in this particular example, we are saying that on this retained earnings, there is a 35% tax rate. So how much are the actual retained earnings? So the actual money that the company gets to retain is 65. On the dividend side, what's happening is, this $100 is being taxed at only 20%. So what's left to pay out? So the money that goes to shareholders is 80. And then shareholders in this particular example are in the 35% bracket. So the shareholders pay a tax of 35. So shareholders are left with 52. Okay, so if for $100 of earnings that were allocated to shareholders get only 52, that means effectively shareholders are paying a rate of 48%. Okay, so that covers this. Okay, so the question is, what about the tax on retained earnings? So over here, the simple point, at least in this particular system, all we are saying is that for the $100 that were allocated towards to be retained, on that we are paying, the company is legally required to pay a tax rate of 35%. Now, I think what you are heading towards is, if you talk about company valuation and so on, then you will essentially look at all the after-tax, the total after-tax cash flows. Okay, so if we look at after, and this is probably going a little beyond this, we'll cover this in equity in more detail, but very simplistically, you can effectively calculate the after-tax cash flows and then use that to come up with the value of a company. And one might make a case that given this sort of a tax system, a company value can be increased by allocating more to retained earnings, because in that case your effective tax rate would only be 35%. Okay, but then you can take that further and say eventually you need to pay it to shareholders anyway, and eventually there'll be taxes anyway, so that can become more complicated than we need to make it right now. Okay, next segment is dividend policy. So we are now on segment 4. Broadly speaking, there are 3 different kinds of dividend policy. One is called a stable dividend policy. This is the most common, where companies try to maintain a steady dividend. Does this mean that the dividend will remain constant forever? Typically this doesn't mean that. This means that dividend is steady, so it will slowly increase either with GDP or with the company earnings or company growth. Another strategy is to say that we want to pay a constant dividend, so a constant dividend payout ratio. So our payout is a constant percentage of earnings. If earnings are high, we pay a high dividend. If earnings are low, we pay a low dividend. So if you say our dividend is always 50% of earnings, that is an example of a constant dividend payout ratio. So the payout ratio is constant as opposed to the dividend being constant. Okay, so I've explained that. And residual dividend policy, we'll see all these in detail. Residual dividend policy is where a company says that I will spend my money on all the investments I need and only pay dividends from what is left, the residue. So earnings first go towards paying for my investments, and then after that what's left is so the left is the residual that is used for dividends. So that's a third policy. Okay, let's briefly cover the stable dividend policy. This is actually the most common, as I mentioned earlier, because companies don't like to change dividends. How do companies decide what dividend to pay? They forecast their earnings on a long-term basis, and based on a long-term projection of earnings, companies figure out, okay, how much dividends can we afford to pay. So not only do they figure out earnings, they also figure out their expenditure needs. So how much money will we need to invest and so on. and after considering all those factors, companies can decide what dividend, how much dividend to pay. This is an example from the curriculum of payout. So look at the point here is that the dividend per share is steadily increasing. Okay, so if you are given this question in the exam and you are asked to identify what do you think the policy is, you will notice that the dividend per share is constantly increasing at roughly the same rate at which overall earnings are increasing, or the adjusted earnings. But what about the payout ratio? The payout ratio is up and down all over the map. Okay, so clearly this company is not doing a fixed payout ratio. It's trying to maintain a steady, stable, growing dividend. Okay. Now, a stable dividend policy can also sometimes be modeled as a process of gradual adjustment towards a target payout ratio based on long-term sustainable earnings. A target payout ratio is a goal that represents the proportion of earnings that the company intends to distribute to shareholders as dividends over the long term. Okay, so this is a testable point. Now, the whole point is this, that let me just do this with an example, and then we can discuss this, understand this better. Let's say a company last year had earnings of 2 and dividends of $0.4 per share. This year, the expected earnings are 2.8. So in general, the company is now doing much better. So earnings have gone up by about 40%. And the company, let's say, wants to, over the years, move towards a 30% target payout ratio. Now, if you want a steady setup, you don't just suddenly bump up to 30. You work up to 30% over a period of time. What's that period of time? In this example, it is 5 years. Okay. So, what is the expected dividend for the current year? The way you work this is, the expected dividend, you take the last year dividend, which was how much? 0.4, plus you take now a fraction of the increase in earnings. What's the increase in earnings? 0.8. We don't just take all those earnings and give them out. We then multiply 0.8 by our target ratio, which is 0.3, and then there is this adjustment factor. Very simplistically, adjustment factor means that if you are doing your adjustment over a 5-year period, every year you make an adjustment of 20% or 1 over 5, okay, which is 0.2. So you multiply this by the adjustment factor, which is 0.2. If this was 10 years, then your adjustment factor would be 0.1. So you do the maths, and that's your expected dividend. From an exam perspective, how might you be tested on this? This would be a relatively simple problem. Your question would say something related to the fact that there is a certain target payout ratio and the fact that the company wants to change the dividend over a certain period of time. Okay, and you just have to remember this formula. The question will be, last year the dividend was this, how much will the dividend be in this year? And you do the calculation.